All right, options traders, listen up. I want to tell you a bit about public.com, but first, have you ever actually thought about all the fees you're paying to trade options? Aside from the regulatory fees, there are commissions, and most platforms charge per contract fees too. That's what makes today's sponsor, public.com, so interesting. Public doesn't charge commissions or per contract fees, and in an industry first, they offer a rebate of up to 18 cents per option contract traded. Check it out. If you trade 1,000 options contracts on Public, you'll get up to $180 in rebates. If you trade 10,000 contracts, you could earn almost $2,000. More importantly, the rebate means you can maximize your profits and minimize your losses. To recap, no commissions, no per contract fees, and up to 18 cents on every contract traded. See why NerdWallet recently awarded Public 5 stars for options trading and start earning up to 18 cents per contract traded only at public.com. This is paid for by Public Investing. Options are not suitable for all investors and carry significant risk. Full disclosures are in the podcast description. U.S. members only.
Welcome to Chit Chat Stocks. On this show, hosts Ryan Henderson and Brett Schaefer analyze businesses and riff on the world of investing. As a quick reminder, Chit Chat Stocks is a CCM Media Group podcast. Anything discussed on Chit Chat Stocks by Ryan, Brett, or any other podcast guest is not formal advice or recommendation. Now please enjoy this episode.
Welcome into Chit Chat Stocks. My name is Brett Schaefer, and I'm joined, as always, by my co-host Ryan Henderson. Today we have, as the title says, portfolio rankings. What stocks are we buying and selling? We're trying to mix things up in 2024, add some new types of episodes to the mix. So we're also doing our stock research episodes on Wednesdays. We're interviewing people, talking about investment legends and how they're, and trying to learn essentially from all the different resources we have out there. But one thing we also want to do is talk about our own portfolios. So we've decided to rank our holdings. We'll talk about the details of that and anything that matters on how we did that and how we're going to try to basically look at stuff on our watch list, look at holdings we have, look at what we like the most out of stuff we actually own, and then also look at stuff that is not our favorite. Spoiler alert, Match Group is quite low for me, for people that have been following how we've been discussing that company and its struggles in 2024. Ryan, what are your initial thoughts on this, and are you excited to get into some, I don't know if we're ever going to, maybe we'll agree on everything here, but some debates and trying to critique our own portfolios.
Some healthy debate, potentially. So full disclosure, Brett and I used to run an investment partnership. We ran it for 3 years, and we would do this every other week. We would just kind of give without kind of looking at, without like just kind of a forced rankings, raw feel. And it wasn't, we weren't necessarily trading on it or anything like that, but it would just kind of force us to give a gut check of where each stock was in our portfolio and just have a sense of, has it moved up? Has it moved down? What's caused it to kind of move down our rankings? Is it something with management? Is the valuation getting stretched? Whatever it is, we used to force rank our portfolio and the holdings in our portfolio. So we're kind of doing that today. We went through the same practice. However, now Brett and I have different portfolios. So we're going to go through some of our shared holdings, and then we're also going to we'll alternate on ones maybe Brett's interested in that I don't care for, or ones that I'm interested in that Brett doesn't care for, or for whatever reason, ones that we have that the other does not. But how should we kick things off? Do we want to just show the pie chart of our holdings right off the bat?
Sure. Those are a little small for the tickers there. I will say they are some beautiful charts that will be, if anyone's wanting to look at some of the visuals here, we will be sending out a free newsletter the day that this releases. So subscribe to that in the show notes. But yeah, I guess we can look at this, and as we're going through it, we can see that we're on fairly concentrated. We're still building out our portfolios over time. Maybe describe yours, Ryan, first. We got a large position in HRBR, Coupang, Philip Morris International, and Nelnet, and then smaller positions in Ally Financial. 2 home builders in D.R. Horton and Dreamfinders Homes, small position in Wise that I believe you just started, small position in O'Reilly, and a small position in Autodesk that I think is been around for a long time. We're going to talk about that one as well, because that's one on my watch list, I believe, or maybe it just didn't make the ranking to talk about today, but it is one that's been on my watch list for a while. If we want to look at mine, have some overlap: Nelnet, Coupang, IAC, Match Group, GoGo, and HRBR. I guess the overlaps would be HRBR, Harbor Diversified, then Nelnet, then Coupang. So 3 ones that I don't own, that I own, that Ryan doesn't own, would be Match Group, GoGo, and IAC. And then I'll just a little context on how we do these rankings. We essentially have a ranking of 1 through 25. So there's 25 slots, but not every stock makes it in there. So you could start your ranking at number 5 and put 5 as your high ranking. And number 1 is basically like, I want to make this my highest level cost basis allocation. 20 to 25 is kind of like, all right, I'm thinking I should sell, and 25 is like, yeah, it's pretty obvious I should sell this thing. So that's how we do it. And Ryan, any other context for just how we think about that? Because I like to, if you have a 1 through 12 ranking, the difference between 2 and 3 might be way bigger than 10 and 11. So it allows you a little bit of separation to think, okay, there's different groupings here. There's stuff that I really like, stuff that's way worse than that. And it gives you a lot more flexibility to, I guess, go through your thoughts.
Yeah, so just to kind of describe that a little further, because it might confuse some listeners. Basically, Brett and I rarely hold more than 15 stocks. Usually it's less than 10. Maybe as we grow older, build out more positions over time, that might change. But that's why we have the 25 slots where it's 1 through 25. Let's say my top holding is Philip Morris. That might only rank number 3. Like it only might fit into the 3rd slot out of that 25, but still be my number 1 holding. So that's just to say number 1 in the number 1 slot in there is you're screaming to buy it today. Number 25 is, this might be ready to sell. And you can kind of scatter them in there. Sometimes things are probably pretty close together, whereas sometimes maybe one stands out above the rest of the pack. But yep. I think we should go through some of our shared holdings here. I want to start with basically the way I did this was those that ranked the highest for both of us. That's the ones we should start with. And so the 2 that were the highest ranking for both of us were Nelnet, and that was your number 1 ranking. And then Nelnet was my number 4 ranking, I believe. So
I see you have it. Oh yeah, 4, but 8 on your 1 through 25. So
yeah, it's the 4th ranked portfolio or company in my portfolio. So why don't we start there? Describe what Nelnet is briefly. We don't want to take too long on any one stock here, and then I can kind of provide some feedback.
Yeah, so the downside of doing an episode like this is we have to go a little bit quicker. So if you want more details on what a company does, a lot of these companies we've covered on the podcast in full hour-long episodes. You want more details on that, go click on those on wherever you get your podcast. You can search through and get that. So let me just go through it here. Nelnet is a diversified holding company. They own financial services. They're in student loans. They also do software and payments for the education space. So they're big into that, and they've become a diversified conglomerate, and they have a pretty darn good track record growing their book value per share. It's about 15% plus over the last 2 decades. And at $106 a share, which is where we're at about as we're recording this, I think Nelnet is still a tremendous value. Makes up about 1/3 of my portfolio. And if I was starting from scratch, I would definitely have this as my first stock to buy. There wouldn't be really any question. I think management keeps proving they can be trusted. Even though they made some mistakes in 2023, no management team is going to be perfect. And they admitted they made these mistakes and that they're fixing them. And it wasn't a big deal to the overall value equation for this company. I think they understand the concept of returning capital to shareholders intelligently. Shares outstanding have declined by about 2.5% each year since 2014. They buy back when the stock is cheap, and they don't when it's more expensive. I mean, you can't, like, that seems like a low bar, but not very many management teams pass it. Dividend per share has grown at 11% since 2014. I see no reason why these 2 can't continue. We have education, software, and payments. It continues to grow. And I guess maybe I can share a screen here of our chart from old FinChat with some of the KPIs here, which, funny enough, since Ryan works at Nelnet and it's kind of an under-discovered company, he put in a request to get the KPIs in there because it's so important to both of us. So thank you.
You said I work at Nelnet? I work at FinChat.
Oh, sorry. You work at FinChat and they put in the KPIs for Nelnet.
Correct. And
Yeah,
everyone
so
knew.
that's a nice catered service our sponsor can do for people. So if you look at it, we see, and some of this was acquired. They do little acquisitions here. We have total growth, cumulative 500% revenue growth since 2012 in that division. Earnings have gone from about 15 million to 100 million, so it's highly profitable now as a market cap of, I still think, below $4 billion with $100 million in annual earnings, growing at a decent rate with high cash conversion. I mean, I think that's just a ton of value to this business. And as we keep going, it's there's just a lot of ways they can reinvest and pour more capital back into things I think can get good ROE or good returns on invested capital. They have the bank that they started, they have the solar tax equity investments, they have the education and payments, and they are going to generate a lot of cash, and they're not afraid to let it stay and pile up on the balance sheet if their stock gets overvalued, if they don't believe that it's a good time to repurchase shares. But if it is a good time to repurchase shares, they're going to be smart about it. So I trust them. I think the stock is cheap, and I think they have a long runway to reinvest. Really checks out all the three boxes. And for the multiple years I've owned it now, it's only further increased my trust in this management team. And that's why I would buy shares today. It is my largest position. I believe it's about a third of my portfolio. So I'm probably not going to be buying shares anytime soon. But if I buy some more stuff and it becomes a lower position, I wouldn't be afraid to add to it.
Okay, so it's difficult to discuss any company in a few minutes, but it's even more difficult to discuss a conglomerate. So I know there was probably a lot there, but the basics of it, there's a giant loan portfolio. The cash is rolling off of that loan portfolio, and they're distributed it into different sets of businesses, which we tend to think are pretty attractive. Now, you ranked this number 1. I ranked this number 4, and I've owned Nelnet for quite a long time as well. I think we kind of bought it around the same time initially, probably around 2020. And there is a lot to like. Management seems very trustworthy. They seem like rational capital allocators. My concern, though, is that as this loan portfolio dissolves, I think there's a decent set of businesses, but I worry that what's left, the operating businesses themselves, aren't going to warrant that much higher of a valuation. Now, obviously, a lot can change with the cash flow that comes in from the loan portfolio, but I worry that it might not warrant that much higher of a valuation than what Nelnet currently has.
Yeah, I could see that argument. One way I think I'd counter that is they're at 1.1 times price to book, and this high cash generating, probably $100 million in earnings or higher in cash earnings from the education software business is not really included in that book value, but they are valued. Book value is a decent measure because they're a kind of investment company at its core. I would say, yes, it's going to come off, but again, the book value is already low, and they've shown really strong performance in having a book value per share compound at 16%. The big question is executing on the switch from the cash cow in the past, which was the highly regulated student loans that they can't do anymore. When they finally switch to all these new ones, is the book value per share growth going to be the same? I think that's the biggest question investors need to ask. But I don't know, at $106, Ryan, do you think it's really getting to a fair value? I think for me, it's more probably 140, 150 bucks, given I know people hate this word, the sum of the parts that I think management can take advantage of by keep repurchasing stock.
Yeah. See, what I worry about is that a lot of the cash that's rolling off the loan book, it's getting put into investments that don't show up in operating earnings. If they're reinvesting into Huddle, they're boosting they are creating value, but it's hard to see it. And so, I guess I shouldn't say that because we don't know Huddle's financials for sure, but we think it's a pretty good investment. That's a private company. It doesn't show up in the operating earnings, but it's just recorded as an asset for them. Same with some of the other venture investments. Same with the real estate stuff. So even some of the solar stuff, it's actually probably hurting operating earnings. So I just worry that the operating earnings aren't going to look that good post portfolio roll off, but you might have this shell of various assets that you have to kind of guess at the value of.
Yeah, and I think it's where you trust the management. And as someone who doesn't need this to do well in a 3-year time horizon, I'm pretty comfortable with that. All right, we got to keep moving on. Second one here, Ryan. It looks like you have Coupang. That's both in our rankings. Let me check your ranking. We have that as the third one, below Ally and Philip Morris, 6 on the 1 through 25. And then what did I have it as? I had it as my second one, but third on the 1 through 25. So about the same range here. Why don't you go first on this one? It's a little simpler. Nelnet's a bit complicated one to start off, but maybe we'll get the hardest one out of the way first. What are your thoughts on Coupang at the moment? Why did you have it as a high ranking in your list?
FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally. And beyond that, they have company-specific segment and KPI data on more than 1,500 stocks. So to give some examples here, you want to see Netflix's average revenue per member over the last 10 years? They've got it. Do you like to track YouTube's advertising revenue? They've got that too. If you want to see Celsius's revenue that comes from Costco, how much of their revenue comes from Costco, they also have that. So the breadth of FinChat segment and KPI data truly is one of a kind. I use FinChat every day to track and manage all my investments. I also use it to discover new investments. And if you want to get 15% off any paid plan, go to finchat.io/chitchat. That's finchat.io/chitchat to get 15% off any paid plan. The link will also be in our show notes. Sound the alarms. We have a new sponsor alert. That's firmreturns.com. It's a stock research blog. Our friend runs that, and it covers companies from all around the globe, but it leans really more towards the UK as that's his home market, and it gives him easier access to management, and he provides ongoing updates on the companies that he's invested in, as well as an archive of longer form write-ups that you can access all for free. There is a paid tier, but there is tons of free content out there. And these reports are very thorough. To give you an example of just how thorough some of these are, at one point he was digging into a company's account, and for one company he wrote up recently, he actually managed to find a material misstatement that had been missed by the auditors, and management reached out and confirmed the error to him.
And these are companies of all different sizes, from all different sectors and all different markets around the globe, but with a focus on his home market in the United Kingdom.
If you want to check this out, firmreturns.com. Like I said, tons of free content on the website. If you're interested in one of the paid plans, you can go to firmreturns.com/chitchat. That's firmreturns.com/chitchat, and it'll get you 20% off. Yeah, so Coupang, certainly simpler than Nelnet. They are the leading e-commerce company in South Korea. If you're a user or an active customer of Coupang, you can buy pretty much anything on there, from electronics to groceries, and it'll be delivered right to your door very quickly. South Korea, for anyone who doesn't know, it's a very dense population, so a lot of people live close to one another. And so Coupang, I believe the stat is, they have a Coupang fulfillment or logistics center within 7 miles of more than 70% of the population. So they are quite close to the majority of the country. And so it just allows them to deliver packages profitably and quickly. And they've invested a lot in logistics. I should mention that. They have really, really built out the infrastructure behind the service. So I think that's probably one of the reasons I like Coupang the most, is because we've seen this story play out before. Now, it's not going to be apples to Amazon necessarily, because Amazon's obviously had some other divisions that have certainly propelled that business, but we know the power that an infrastructure advantage can have. And you look at, for Amazon, we've already seen it, but with Coupang, when you have a logistics advantage over competitors, it affords you a lot of other opportunities. It helps you win on delivery times, which enables you to deliver more items. You can start to deliver things like groceries because they kind of have that short shelf life where it's not as easy to deliver. So being able to deliver more items more quickly. It allows you to add value accretive products like the Rocket Wow subscription, kind of similar to a Prime subscription. It helps you, which helps you boost profitability, which helps you reinvest in the whole cycle all over again. And it's just this very fortuitous, very advantageous reinforcing cycle that they have. It's almost this, I know I've used this word a lot on recent shows, scale economy shared principle, which is kind of a fancy way of just saying it's a non-zero sum business. When Coupang wins, the customers win, and they're reinvesting a lot of the profits into furthering their advantage. I really like the setup here. The CEO and founder, Bam-Soo Kim, owns a ton of the stock, and he seems very intelligent about the way he runs this business and invests for growth. So I really like it. It's my third largest holding, actually maybe my second largest holding. So, and it's actually one of the few winners for me, which is nice. Brett, I believe you own this one as well, right?
I do own this one as well. It is my second largest holding at the moment, around 20% of the portfolio. And yeah, that has happened because it has appreciated a little. I will add on to this that Ryan was talking a lot of the good kind of anecdotes in the narrative, but the financials have backed up the thesis around the competitive advantage, where they're outpacing retail growth in Korea. The margins are expanding, and now they're very, very much self-funding. They're generating a lot of cash flow. On a GAAP operating margin basis, they're just slightly getting to positive, but again, there's going to be a lot of inflection here, hopefully, as they scale, but they are reinvesting a lot. And I believe the number, look, they're generating plenty of operating cash flow and have plenty of firepower to reinvest into new capital expenditures in both South Korea and as they expand in Taiwan. If you want to listen to a full episode, and we'll break down all of that, we have a full episode on Coupang that you can listen to. I think two, actually. The thing is, the stock still isn't that expensive if you kind of map out what margins could be like and just assume, hey, honestly, a decent slowdown in revenue growth. So I think the stock is cheap. I think they have the competitive advantage that's showing up in the financials that matches up what you read about with the company and how smart the management team looks. And the last few earnings reports, I just have no complaints about this company, which you can't say about a lot of especially consumer-facing companies around the globe at the moment.
Yeah, totally agree. I'm sharing a bunch of charts here of Coupang. The net revenue per active customer has grown very quickly over the last couple of years. And then you can see here, they track the total leased and owned fulfillment and logistics square footage. So basically their logistics footprint. And it's gone from 25 million square feet to 55 million square feet in 3 years. So they, like I said, they invest a ton into their logistics, and they also own the delivery network as well. And that's becoming its own revenue driver because merchants are willing to pay for fulfillment by Coupang, which has been profit or margin accretive as well.
Okay. Next stock, and I think I want to focus on this too with the rankings, is when we first come to the company is what was our gut check when we looked at it. So I look at your gut check on this next one here, Philip Morris. It was your highest one, first of that you put on here, third in the rankings, which means like not I'm loading up the highest cost basis I've had, but it's the first one you would buy if you're starting a new portfolio from scratch today. So what was your gut feel without first, obviously checking the numbers to make sure they matched it? What was your first gut feel for Philip Morris here as we move on to our third stock?
With Philip Morris, I look around in my day-to-day life and I am blown away at the stickiness of one of its growing products, which is Zyn. And people, especially in the Northwest here in the United States, it is becoming such a common trend. It is allowing them to grow so quickly too, because people see other people that have it, and it's like this free marketing. It's almost it's literally like a network effect. Your customers become your best salesmen. I'm sure you've witnessed it as well.
Yes, and for the annoying listeners that want to correct Ryan here, I will correct him. It's virality, not network effect, but I think they understand. And I understand
Virality
it all the time.
Sure. So it's one of those where I see it all the time, and I just think they've got their customers hooked for quite a while. Now, probably quite literally because there is an addictive substance there. But they've got their customers hooked. People pay a lot for Zyn relative to some of the discounted competitors. And I've asked people, I'm like, hey, would you ever go with some of the competitors like On? And they're like, what are you talking about?
Small
They're
purchase price.
like,
That's the
what,
beauty
there's a
of it. Small.
competitor? Like a lot of people
Yeah.
don't realize that Zyn's like one of a few.
Yeah.
And then the ICO seems to be going well. Also, now I don't have quite as much experience with that because it's mostly popular in Europe. But basically, you've got a business where everyone I talk to in the investment community, when I mention Philip Morris, they all think, first of all, they ask, what were the returns of the last 10 years? Which it was a very
Bad.
different business 10 years ago than it is today. And they say, oh, no, cigarettes are a dying business. And
Or they talk about Forex ruining all your cigarette profits.
yeah, and so people just tend to think that this is a legacy cigarettes business that's going to probably go nowhere for a while, when in reality, I've got this quote here from, we did 5 stocks we'd buy today episode a while back, and I said, it's somewhat ironic, but I think Philip Morris, which is one of the oldest publicly traded companies around, will be one of the most surprising growth businesses of the next decade. I still believe that.
I agree with you. Yeah, I think IQOS and the nicotine pouch business can do quite well. Look, is it going to turn into a $10 billion earnings business and replace the profits from cigarettes tomorrow? No, but could I see that happening within 7 years while the cigarette business is still there? I think that's possible. And if it doesn't reach that, then, well, you get a 5% dividend that hopefully can continue to grow. The big risk, of course, is foreign exchange for a United States investor, but I think there's a lot to like, and the cigarette business for them, the tobacco business, I guess, not just cigarettes, globally, is a lot more attractive than the United States.
Yeah, and to kind of sum things up here, the cigarettes business, people think of it as this like declining ice cube, melting ice cube, whatever you want to call it. Last year, or the most recent quarter, cigarette volumes were flat year over year internationally for Philip Morris. So it's actually not declining that quickly abroad. It's certainly declining fast in the United States, and revenue was up 3.5% for combustibles. So it's still, for the moment, a slow growing business.
Yeah, and the good thing about this company is that they have the replacement products for a lot of people that still like nicotine, that are much healthier. Okay, with this one, I should say that I don't own the company, 0% position, but it was up there on my watch list, I guess, or excuse me, the ranking here. I had it as actually number 9 in the 1 through 25 ranking and behind 2 other stocks that I don't own, but above 3 stocks that I do own. So I think making this ranking, I may have some choices to make for portfolio changes. What do you think? Let me show the ranking here, Ryan, and see what you think.
I think it's
How would I say?
funny that you have all these companies that you rank so highly that you just don't own.
Well, I would say, I mean, like, I don't have unlimited funds, and I was saving some of the decisions for this portfolio discussion. Plus, we just had earnings, so some of the stuff changed a little bit after this quarter. If
All
that
right.
makes sense.
True. I guess there are some companies that I've wanted to add that I've just been holding out on because, yeah, like you said, not unlimited funds.
Yeah.
Or maybe
So
you just don't want to sell something for the taxes to fund something else.
yeah, and I guess maybe yeah. Well, no, it's a tax free account, so that has nothing to do with it. I think I would have made the decision before this recording, but I wanted to do it, you know, for this episode, just for the listener. I don't think that the stock prices aren't going to change that much. I guess we probably need to go through some of these other companies first before we hit the discussion questions, but I just wanted to show my ranking here for the video, which you can also find if you're a listener. Sorry, I know this is a little tougher for the audio here, but I think people still like the discussion. If you want the visuals and the charts and the rankings and the pie charts, subscribe to the Substack. That'll help out. And that's all free. Okay, next one, Ryan. What do you got? Is
This
that
is
the
the last
last
one
overracking one?
we
Or
both own. Well, I guess you didn't own Philip Morris, but this is the last one we both own. So a shareholding. I guess I'll just go through a quick summary on what it is. And before I say that, I should mention that this is super illiquid. It's kind of a crappy company. Maybe. Oh, I feel like I'm fairly comfortable saying that. And it's a company that doesn't really even want to be public. So there's some risks, huge risks. And so don't, do your own due diligence, all that stuff. With that said, this one that we both own, it's Harbor Diversified. It is the parent company of Air Wisconsin, so it's just a regional air carrier that operates routes on behalf of, I believe it's American Airlines. It was previously United Airlines, and it's based. The only reason that I own it, and I assume Brett, you're probably in the same situation here. It's trading. It's like a cigar butt. It's trading at a dirt cheap valuation, in our opinion, and if it gets re-rated at some point, we think there's potentially some big upside. Now, I don't know if we need to go that in depth about the business because I don't think it's that important, but I'll put some numbers on it and then I'll throw this question over to you, Brett. So the market cap right now, there's some, I think it's convertible debt where if that were converted, the fully diluted market cap would be $102 million. They have net cash of $106 million. So the enterprise value is quite literally negative $4 million. In their good years, so when things are operating normally, which is uncommon in the airline industry, it seems, they can generate $20 to $30 million in profits. At least that's what it was at the peak of their United deal. So if things were progressing normally, they were generating $20 to $30 million in profits, they would be trading at, they'd have that negative $4 million enterprise value. They'd have tons of cash. They could probably buy back 50% of their stock and be totally fine. So that's why we think there's a lot of upside. However, they have not filed their 10K for the year. They announced that they needed to delay it because of some accounting problems where they're having a hard time reporting it on time. And they delayed their 10Q. So I'm a little worried this is going to get delisted.
Yeah.
Thoughts here, Brett? What are your concerns? What do you think? What are your updated thoughts on Harbor Diversified?
Yeah, so one, I would say, note on the accounting stuff. They had a dispute resolution with United, and it's not like they basically said that their balance sheet is the cash is still there. Nothing was discrepancy on the cash, but they had this receivable stuff that they were accounting for, and it has to get restated in a lot of their financials, which doesn't affect the cash position. So the business is operating the same, but since they probably have a tiny accounting department as a microcap, it's just going to take them a while to do that. And there is the concern about the delisting. That's definitely the number one downside here. I would say if you own it, but I still need to do this. I should do this now. I should honestly do this after this episode, is you become a registered shareholder, which DM me if you want to figure that out. But the upside there is high. They're buying back a lot of stock. I think they've reduced share count by what, like 20% maybe? On not including that preferred stock, maybe it's closer to 10 to 15%, which I think is nice.
I'll check right now.
Yeah, you can. Yeah, you do a little check. The EV is 0, and they can generate $20 to $30 million a year, return cash to shareholders. The debt is getting paid down. They actually had a weird thing where I don't know what was happening with the liquidity with their banking partner, but they had this debt, and they had plenty of sizable net cash position, but the company called them out as being, what would it be, in violation of one of the covenants of the debt, so they forced them to pay it back. It might have been because the bank was trying to be a little bit sleazy and they were having liquidity issues, but they paid that back, so we're having essentially a really, really cleaned up balance sheet. And you have this just cash sitting there. It's going to earn interest income. They can buy back the stock if they start generating cash. But the thing is, I don't know what the numbers were after September 2023. So it's tough. They have a Twitter account that tweets that they're still in business. They're still making their flights. I think the pilot shortage is getting better. So I think they're probably at least break even to hopefully slightly profitable. American Airlines is helping them hopefully to get a slight profitability. I think the upside would be a 3 to 5x if things work out here. But the downside is, look, could get stuck and get delisted, and you might just be stuck in this thing. So that is why it is in my hold position. It's going to be a small. I had it as number 10 out of the 1 through 25 here. And it's kind of like, I'm not buying. I'd like to keep this as a small position, but I think it's a good one, especially when at this moment, a lot of the compounder stuff, a lot of the big tech, a lot of everything that we kind of looked at or have looked at doesn't seem that attractive to me when compared to this at the moment when valuations seem, I know this might be hearsay because we're in an AI utopia, but they might be a bit stretched for a lot of stuff out there.
Earlier in the show, you heard us talk about the investing platform, public.com. That's where you can trade options with no commissions or per contract fees, and you get a rebate of up to 18 cents per contract. NerdWallet recently gave Public 5 out of 5 stars for options trading. If you want to see why, go to public.com and start getting a rebate of up to 18 cents per contract traded. This is paid for by Public Investing. Options are not suitable for all investors and carry significant risk. Full disclosures are in the podcast description. U.S. members only. Yeah, it's one that's almost funny to own in a way because the problems that they have are something I've never experienced with other companies that I've owned. Like, they literally don't have enough people or enough time in the day to fix their reporting in time for the SEC deadline. So it's a resources issue. However, the incentives are there, right? Like the people that run this company own a lot of the stock. American Airlines doesn't want its regional air carrier to fail because that becomes an issue for them. Those routes
Customers
are
are
not
upset.
economical. Customers are upset. It becomes difficult on them as well. So they have all the incentive in the world to help them out. And if things go well, yeah, this will turn out great. But on the flip side, your downside is not like, oh, revenue underperforms or something. It's like you can't sell the stock because it's delisted.
The investment group that controls this might take it private at a dirt cheap cost, or but the thing is, I think from the upside is the investment group, like you mentioned, wants this stock to do well, and they seem to have the patience, and they like to buy back, and they seem to be doing a lot of good things from a capital allocation perspective. All right, let's keep moving on here. I will say we probably won't get to all of my rankings, but I will tell you, Ryan, just given our discussion questions, I want to hit all the ones I own. So IAC, Match Group, and probably the two ones we definitely want to hit from me that were ranked higher than some of the stuff I owned would have been Portillo's and Nintendo.
Okay.
Which
Sure
both
thing.
can be fairly short, but I think those would be good discussions because I can compare them to those, and maybe for you we can do some whatever you want, but depends. We don't want this to be a 2-hour episode, you know.
Yeah, so we're doing this on the fly. I know you hate when I do this, but I'm going to do it anyways. Let's put the stop clock on and let's give each other 2 minutes. 2.5 minutes for each company to give your spiel, pitch, and I'll give you some feedback.
Okay, well, what one do you want to go first? What one's first on your list?
Let's start with, you want me to start? Or do you want to go?
I can go. Just tell me.
Let's
tell
go
me what
IAC.
Okay.
Since that's a large holding for you.
Yeah,
and then
let me pull up on the notes.
Got my clock here so everyone can see.
Talking. Yeah, let me fill in the notes. Okay.
When you start talking, I'll hit start.
Yeah, this is one of the lower ranking stocks I owned. I have it at number 14 on the 1 through 25, and there are multiple stocks that are above it. I will say Portillo's, Nintendo, and the aforementioned Philip Morris International. I could see myself deciding to sell this position if I see some of these other stocks and I kind of weigh them. I think it's better. Look, on the one hand, positively, IAC trades in an enterprise value of about $1.27 billion if you net out its investment in MGM Resorts, Angie, and its net cash position. In theory, this is a discount to its Turo stake, Vivian stake, and the wholly owned businesses like Dotdash Meredith and Care.com. I want to like this thesis, but I worry that management is not really executing, has had its eye off the ball for a while because the Dotdash Meredith acquisition, or excuse me, the Meredith acquisition was bad. Care.com has stagnated. Management is not repurchasing stock when they keep talking about a sum of the parts discount, which someone like Nelnet is actually doing. But IAC is like, oh, well, we're just going to sit on this cash pile, so I don't like that. I worry about the generative AI stuff taking a lot of the share from Dotdash Meredith and really hurting that business, which I think is the clear competition for that. And I'm losing trust in this management team. I have been losing trust for multiple years now. Do I think the stock is undervalued? Yes. But would I rather own a stock where I trust the management team and I think it has a similar upside? Yes. because one thing I think investors have to get, and I do this and Ryan does this, I know almost everyone does this, is you're so afraid to sell something because you would hate to be the guy that's like, I sold IAC at 50 and then it's at 100. But you have to think, do I like these two different stocks the same? You know what I mean? You don't want to be that person. You hate envisioning yourself being that person. And I think you try to understand you're going to have that bias and maybe try to ignore it as best as possible.
Yeah, so this is one where we've historically had some disagreements on IAC a bit, but it sounds like you still kind of have a similar thesis that the valuation could look really great, but management's taking its eye off the ball. And so it sounds like maybe we share some similar concerns now. When would you, like, excluding opportunity cost, excluding, oh, something else came up, I need to sell this, what would cause you to sell IAC?
Just in a vacuum, I would say, so this year they're showing some decent progress on Dotdash Meredith, and they're supposed to have consolidated free cash flow again, that they can build up their cash position, hopefully look for target acquisition opportunities. And if that doesn't happen, that's a negative, and I would sell. And also monetizing the Turo stake. I do not know why Turo is not IPOing when markets are at all-time highs, excuse me. It doesn't make any sense to me. And I would think that they'd want to take advantage of that, especially because if they could sell the position, buy back a ton of stock, all that good stuff. That's the type of stuff they were historically known for, and creating a lot of value for their shareholders doing that. That's why people used to call them the golden goose. But today, I'm just not seeing it. And I think there are some stocks on this list that I like better, but we'll have to discuss those as we get to them. All right. What do you want to hit, Ryan?
I'll talk Ally Financial. This is 7% of my portfolio, and feel free to start the clock whenever, or the mental clock here, Brett. I ranked it the second highest. It's probably interchangeable with Philip Morris for me, but Ally is a pretty simple thesis. It's a digital-only bank, and as with any bank, there are two important things to look at. Where do they get their money, and where do they put it? With Ally, they attract deposits from consumers by offering them a high rate on their savings accounts. For anyone that doesn't kind of know the digital banking space, this is becoming more and more common now, but by not having physical branches everywhere, they save a lot on costs. They're able to pass through this cost in the form of higher savings rates to their customers. And that in turn attracts a lot of people because people want high yields, high interest on their savings account. So that's actually helped them attract, I think it's almost $150 billion in customer deposits. The good thing about customer deposits is, for one, it tends to be sticky because it's widespread. It's not, unless you have like 10 customers that are all the same family members and they all think the same, you're going to have widespread assets. So no worries about like fleeing deposits all at once, like you might have had with Silicon Valley Bank. And then it's low cost. It's the lowest cost form of deposits, I believe, that can be pulled in as a bank. So I like the deposit side of the balance sheet. On the flip side, they lend primarily in the consumer automotive industry. And even though it's been kind of a tough year because interest rates have risen and there's been some compression here, and even default rates on auto loans has gone up a little bit, it's still a good place to lend, right? Cars, the duration on an auto loan is not very long. I believe the average is 5 to 7 years. And so it gets paid back pretty quickly. The default rates are pretty low because you think about how important a car is to a person. It's one of the first things you're going to pay back, because without a car, you can't get to work. Without work, you can't pay your bills, all that stuff. So I like the loan book in general. However, there's been some contraction in the net interest margins, and that kind of hurt them in the short run. I think, moral of the story here, they can get back to earning their historical margins, which means it trades at around, if they get back to $7 in earnings per share, they're trading at like 5 to 6 times earnings for a growing business.
Beautiful. That was almost exactly 2 minutes and 30 seconds. They're like 2 minutes
Nice.
and 25. Yeah, I think I forgot about this one, putting on the watch list. I think looking at your chart here, which we don't have to show now, but in the newsletter, the jump between 2019 and 2020 on those interest-bearing deposits, and you wonder why we had inflation when we just injected money into everyone's bank account. But that's besides the point. I should have had this on my list. I kind of just forgot about it. I think it's more lower for me than a couple of the other stocks that I had higher. As people maybe remember, I had 3 that were kind of higher that I don't own. It's about $38 a share. I think I like it here. At $25, I really liked it. But I think given the high dividend yield and the fact that they buy back a lot, $25 is a big difference $25 is a big difference to 38. Maybe I'm greedy, but there's some theory I have in my head that I want to buy this during a recession. But who knows? Like predicting that, I don't know. I don't know if that's going to happen.
I think that already kind of came and went.
Oh, Ryan, don't jinx it. Don't jinx it. I mean, we did not have a recession and the economy is absolutely booming. So,
No, I mean, the concerns around a recession really impacted this stock for quite a while. Carmageddon certainly scared a lot of people out of this.
Yeah, for sure. I mean, 25, I thought I think we both would have had it in our top 5, and we did. Back when we ran the partnership. Okay.
Let's talk our shared hatred for Match Group.
What?
I said, let's talk our shared hatred for Match Group.
All right, yeah. I'll sum things up. We've done a lot of talking on this. This one was, I put it 17. There's the last one I ranked of all the ones. I couldn't rank everything on my watch list, but 17 of the 25. That's close to like considering selling in that range. And let me just kind of go through my notes. Essentially, they failed to stabilize Tinder. When I made the thesis, when we both made the similar thesis, we thought steady growth at Tinder, explosive growth at Hinge was supposed to deliver 15% to 20% revenue growth for the next few years. Well, that happened at Hinge, which is great, but not at Tinder. Tinder MAUs are declining, monthly active users, I should say. Management has not been able to fix the bleeding, and I am uncertain of whether they can. Also, management is doing a lot of things that is making me lowering their trust in them. Now, there's a lot of people that I think are they're quick to make a snap decision and say, just because management said one thing one time, they're the worst. They're the worst. And then when the stock price rises, they're like, oh no, it wasn't a big deal. So I don't think you should look at it this way, but there's been multiple times when I think management has said things about users, said things about payers, said things about all these KPIs that they're a little bit vague about that can mislead a bit. So they said something about Tinder being the majority of their MAUs a couple of years ago, and then out of 100 million or something like that. So you would think like 80 million MAUs. But then they go around this week and start saying, no, their peak MAUs was 55 million. So it's hard for me to say. If you asked, is Match Group's management honest? I might say no. But on the other hand, stock's very cheap. Revenue's still growing. Cash flow is still there. EV to free cash flow is 12. They're buying back a lot of stock. I like it here. Obviously, I made a mistake buying it at like 60 to 80. But the question is, should I switch this out for another position? Is Philip Morris International an easier compounder to own? Not that Match Group's a compounder anymore, but I know that term gets co-opted. Ryan, what are your thoughts?
My thoughts, and our friend Alex Morris kind of brought this to my attention in his article. They tend to speak in misleading generalities, is maybe the way I'd say it. Here's his words. So, where should I start? In my mind, okay, he says, the last point is important. As discussed in Feeling the Heat, my sense is that management has its back against the wall and has struggled in the face of generally underwhelming short-term results. In my mind, that continues to show up in the way that they stretch the truth in optimistically presenting certain figures. 2 examples from the most recent quarter. Tinder has, in quotes, just under 10 million payers, when the actual figure is 9.7 million. And saying they repurchased roughly 6 million shares when the actual figure is 5.6 million shares. Now everyone, I feel like a lot of people do this, but they round up to whatever figure is best for them. And they said they had that, we're almost hitting 100 million MAUs like 3 years ago. And they made you think that like Tinder was at probably 80 million. When in reality, Tinder was at 55 to 56 million. It's just, They give you the data they want to give you, and that really irks me. I've
All
actually
right. Yeah.
sold out of this. I did own it for a while, and I
Yeah.
just grew frustrated with it.
Yeah. I think like looking at this discussion question I had, I think there's other stocks I can own that are better risk rewards here. And maybe we can get into one of those next. What one do you want to talk first? I know we might not get to go on this list. I would say just listen to the stock research report I have. That is one of my positions now. I had it third, and it's one of the solid ones I have along with Nelnet, Coupang, and GoGo, where I definitely add to my position. We might not talk about that one, but maybe we should talk about Nintendo or Portillo. Is what one do you want to talk about first?
Here, let me maybe discuss Autodesk, because this is kind of one of my other holdings here,
The
and we can
same
just
group of same type of styles Match Group on my watch list as well. And even though I didn't include that in my rankings, but definitely it's on my watch list as well that I track.
Yeah, so I own this. It's a really small position. I've owned it for a little while, and I'm not sure what to do here, honestly, because I kind of despise management more so than I despise Match Group's management, because they seem to measure themselves by metrics that are completely irrelevant for
Oh, they're
minority
definitely
shareholders.
worse because they don't
Yeah,
understand capital allocation at all.
yes, that's certainly what it seems like. And I guess I'm holding out hope that an activist takes over or someone replaces the CEO, and or maybe even the CEO kind of finds religion and says, "Oh, I guess we don't have to grow costs faster than revenue since we're a completely scaled business and our incremental margins are super high. Maybe we don't need to waste all this money. Maybe we don't need to spend $500,000 on a Sphere ad." It's
Yeah.
frustrating to me, and they don't take hard questions at investor days. They are actually having like a bit of an accounting scandal right now. And instead of delivering a report describing what's going on, they decided to buy out some AI company instead. That's not
You
going to
like
make
that?
the
You
that's
like
not going to
someone
make
tweet
the
on that?
accounting more complicated.
Yeah. Their capital allocation is amazing. Here's what my question would be on you, Ryan. It's 2.9% of your portfolio. It's been sitting there for a long time. You haven't added to it clearly, but you have other positions that are, I'll list up all of them that are below 7%. Allied, D.R. Horton, O'Reilly, Wise, Dreamfinders, Homes. Why not just take that Autodesk and put into a couple or one of those? Because those aren't going to turn into outsized positions because of that. I would think maybe a little shakedown, trim in that position could help out.
Because so it's a small position. I think I have like very few shares in there. So it's not, I'm kind of just going to let it ride. And my thought process there is this product is so ingrained in the day to day workflow of architects and engineers that it's still going to be relevant in 10 years. And maybe one day a CEO comes along and demonstrates that to shareholders. So I'm just kind of hoping.
We might need to move back to go forward. Hopefully the share price collapses. We get some activists in there.
Yeah, I guess I've been thinking about selling it every time the CEO speaks. I just kind of think like I'm getting rid of this just out of spite. But it's one of those where like you want a business so good, even an idiot can run it. I hope that's the
They're
case
almost,
here.
yeah. But it should be the case. The revenue just keeps growing. It's going to grow whenever they want, and margins are great. But yeah. All right. What one do you want from me? Nintendo or Portillo's?
I want your updated thoughts on Nintendo.
All right, let's go through. This is a bit of a weird company. I'm just trying to go through our notes here. We got a lot here. We'll say. Go subscribe to the newsletter to get the full stuff because I know sometimes it can be confusing. I want to say that multiple times this episode. So, start the timer. Nintendo is an easy one for my watch list. You have a stock trading at a market cap of $60 billion, about $60 to $70 billion. The yen gets a bit crazy. So it can change rapidly in USD terms, especially with the yen depreciating so much recently. And first up, the company has a rock solid group of entertainment characters with durability among different generations in multiple places around the world. Probably Disney is the only one that can say that. As long as the yen doesn't go to zero, which I think I guess it's trying, but who knows? I think they can generate about $5 to $6 billion in annual USD operating profits once this new console comes out. Management finally said it will be coming out with a new one in around a year. For a business with this much durability of, say, relevance, and someone who's focusing on extending their life cycle over the long term, I'm comfortable having this in my portfolio when I think the normalized earnings is about, if you take out their net cash position, it's about 10 times earnings. And if you add in the movies and theme park upside, which they are reinvesting in decent amount, there's a lot to like about Nintendo. Here's the thing I think investors need to think about, though, with Nintendo. You have to be patient. They make plans on a 10-year time horizon or longer, so you should too if you own the stock. Don't get impatient with this one. If you're an impatient investor, this is probably not for you. I think the stock probably outperforms in the next 5 to 10 years and can start returning tons of cash to shareholders, given they've built up their conservative balance sheet, which was their goal over the last few, basically the last 10 years. And they have started returning cash to shareholders with the repurchases and the dividends. That I think our friend at Best Anchor Stocks, Leandro, has said like they've returned 70% of the earnings they've generated. I forget his number, but I would have to confirm with him. That's just something I read from a tweet. And yeah, I think it's just a good risk reward here with durability over the long term.
So I showed a couple charts there for anyone who's not watching, and basically it looks super cyclical, right? There's like throughout, I think it was 2008, maybe it was 2009, revenue peaked with the Wii, and then it's since come down. Then it looks like it peaked again in Q3 of 2020 and has since come down. However, I think a lot of people look at this and they think, first of all, that's in USD terms, not in local currency. In the yen, it looks a lot better. I'll actually pull that up right now. It's growing
I think
year over year in the yen.
One argument I make there for the people that have that pandemic affected this one, maybe even try to normalize that a bit. And FX has been really tough for USD shareholders right now.
Yeah, actually, if you strip out the pandemic boom and you just look at it 2019 to 2023, you would think this is like a steadily growing business.
Yeah. Now this year's going to be
in yen terms.
Yeah. Now this year is going to be there. They just announced, like there's usually all these rumors and people trying to predict it. The management team announced that the new console's coming out within, I think, a year, which they usually are good on. That means it's probably almost ready. They usually just take their time on this thing. So this year they're not going to have any big blockbuster games that come out. Most likely it's going to wait. So earnings will be down for a little bit, but they're still going to be positive. And before they would like go to zero for multiple years and then they'd come out with a new thing. I think this time it's going to smooth out the earnings cycle, and the downside is not high, in my opinion, over a 5 to 10 year period. And I think there's a lot of upside if the earnings can grow, as I think they can.
Do we want to discuss any more companies, or do we want to hit the wrap-up questions?
Well, I think Portillo's is an important one to hit because it was the highest ranking stock I didn't own. Yeah, I can sum this up quickly. We just did a show on them. I don't own it right now, but essentially how I look at it is, today they're at about just under $10 a share. I'm seeing a fully diluted market cap, $700 million, EV of $1.3 billion, even if we include this liability they have for tax receivable stuff. If I'm right about the unit economics, which I think are solid, I'm right about the expansion plans, and I think they can generate around $1.1 billion in restaurant profits after accounting for their new build costs cumulatively through 2030. And I think that's an attractive place to be, where you have a market cap of $700 million, EV of $1.3 billion, and a lot of restaurant level profits flowing through. I think the stock is cheap simply because of that. And people are worried about a comp sales slowdown, which I believe is a macroeconomic thing, because I'm seeing it in a lot of restaurants. Portillo's is not specifically like we're hitting negative 1% comp sales and everyone else is hitting 5%. I like the management team. I think their experience in restaurant brands is good, and I think they can get good volume and good ROIC that's stable. I don't see why this isn't a good risk reward at these prices. It would not be like a Nelnet position where I think it's diversified, low risk, low downside. But if I'm right, I think this is a 10 bagger. If I'm wrong, I think, it can go down a good amount, but investors might be underwriting the upside at the moment. And I ask myself, why shouldn't I own this? Why do I not own this over IAC and Match Group when there's probably similar upside but less frustration with the management team?
Sorry, I was on mute there. Yeah, I like it a lot. We did a show recently, and I came away fairly convinced. It is at all-time lows here, and it's a business where the actual stores themselves have such a fanatic following. People love the food. They have, like, the restaurants themselves do some of the highest average volume in terms of revenue of any fast food restaurants in the United States. That tells you how much people like Portillo's. It's just really a matter of expanding and doing so somewhat cost effectively. I think the economics will be good everywhere. At least, like, maybe they won't be as good as they have been, but I think they'll still be okay.
Yeah, still be positive. ROC is high enough where if it comes down a bit, we still do fine. Are there any stocks you want to hit in your list, Ryan, pertinent to this episode? I think one thing you'd probably agree with me listening to on this, when we do these type of things in the future, we should probably do one at a time because there's just too much for each person.
Stock wise, or sorry, repeat that?
Yeah, so if no, one ranking, like one person does the ranking, like you would do the ranking, we would talk through your whole portfolio for a full podcast, and then you know what I mean? Because I think we could go 2 hours if we hit everything for each of ours. But on this episode, to try to cut things not too long, is there anything else you want to hit?
I'm okay. I think we covered most of it. Let me go through my rankings here. It's going to take me a second to pull them up. But I will go through it here. Speak for a second, and so that I can put myself on mute and start typing to find this.
I'll do my list first. How about that? So remember, this is 1 through 25, and the 25 plus, I just include some extra ones that are on my watch list that I think are just a bit overvalued. So not every slot's going to get filled. So 1, Nelnet. 3, Coupang. 5, GoGo. 6, Portillo's. 8, Nintendo. 9, Philip Morris International. 10, HRB, Harbor Diversified. 12, Airbnb, which looking back, I think I put that too high. 14, IAC. 15, Visa. 16, American Express. 17, Match Group. And then 25 plus other stuff I'm watching that I think is just too much. Like the price is just crazy right now. Sprouts Farmers Market, Adyen, Spotify, Alphabet, and Amazon. Ryan, what does your list look like?
I'm just going to do them in terms of the actual companies, because I think the slots might confuse people. So number one company, just in terms of opportunity, where I think the downside could be, downside protection, all that, Philip Morris for me. The second one and the third one are kind of interchangeable here in Ally Financial and Coupang. Fourth one is Nelnet. Fifth one is DR Horton, which we didn't talk about too much today, but I really like them, and they check a lot of boxes for me, and I think it's a competitively advantaged business. This would be sixth, is Wise, which I might have some recency bias there since I bought them fairly recently. And then 7, O'Reilly Automotive. 8, Harbor Diversified. 10, Dreamfinders Homes. I think it was 9, Dreamfinders Homes. The last one, Autodesk. So this brings us to a wrap-up questions. If you got new money into your portfolio today, which of the companies would you add to? Which of the companies we discussed today would you most want to add to? And then which of these are you not even close to adding to?
And this is including watch lists, not just ones I own.
Yep.
Number 1, and I do have some cash in here, is Portillo's. I think next one would be GoGo, even though we didn't talk about that, but we did a full hour-long research report on them recently. After that, I think Nintendo, then Philip Morris International. Those are kind of the 4 I'm looking at to build out positions right now. And then the opposite, I guess we're mixing in a lot of these questions here. I think I can kind of lead into the second one here. If I was to sell something, where would I fund a new purchase? I think, honestly, I like a portfolio of, I'm trying to list it off my memory, Nelnet, Coupang, GoGo, Nintendo, Philip Morris International, Harbor Diversified, Portillo's, I think those are all. I'm trying to remember them by set over the one I have right now with IAC and Match Group. So I think I should sell those two.
I agree.
So I think I like those better.
But don't let me give you just confirmation bias here.
I know. I was thinking this before the episode, and that's why I think the gut feeling with those rankings were higher. So I think those are the four I would add to. One I already own, but the three that I don't own are Nintendo, Philip Morris International, and Portillo's. In the investment partnership, we owned Nintendo and Philip Morris International, so I guess technically I have owned those in the past, but Portillo's would be the newest one I've hopefully discovered this year. So we'll see. What about you? What are your final thoughts, I guess?
What would I add to?
All these discussion questions you have listed here.
The one I'd probably add to today is, I mean, there's times where I'm just building out a position just to like, Wise, for example, it's traded on the OTC markets. Their ADR is here. So there's commission costs. So sometimes I'm just like saving up cash to buy it in bulk so that I don't have to like, the commissions don't take out like 3% of the cost of the purchase or whatever. So I don't know, there's some irregularities like that, but I think if I just had blank check 10 grand, what would be, or however much, what would I want to throw it at? Philip Morris ranks the highest for me. I really do. I think they're going to be an underappreciated growing business over the next decade. I could see them growing earnings per share by well north of 10% for quite a while and pay you out a 5% dividend yield in the process.
So you feel like there's a low downside there, and that helps you not be afraid to size up the position.
Yeah, absolutely.
Okay. Yeah. I think that makes sense. Yeah.
Other one, I've been building out Wise as a position a little bit lately, but it's probably not the highest ranking for me. Coupang's kind of re-rated a little bit. Maybe I'm just kind of anchoring to what I bought it at, but it's re-rated.
Yeah, I would say
slightly.
I think Ryan. Yeah, I know I have my biases that you call me out on. Your anchoring bias is I think
strong.
It's
strong with this one. The trying to think of other ones. I like O'Reilly right now, but the only bummer is shares cost $1,000, so it's a little like if you had if you're adding like $500 in cash or something like that, you kind of have to do it in lumps, I guess. Which is
I'm looking at the home builders. Do you want to build that as a bigger position, or would you like that as like a kind of a 10% of your portfolio?
I'm comfortable building out D.R. Horton. Dreamfinders Homes I've soured on a little bit. There's just been some red flags since I did that
Florida
episode.
Market, tough too.
Yeah, and I just kind of there isn't a real competitive advantage for them in terms of building. Like they can't build cheaper than some of the big ones. Whereas D.R. Horton, they are basically just a manufacturing business, and they manufacture for cheaper than the other manufacturers.
Right,
and
lower downside.
It's not really. D.R. Horton used to gamble on real estate just because they would buy the physical land. They don't do that as much anymore. 80% of their land is owned in land options. So I would be very comfortable adding to D.R. Horton. It's probably up there for me. And it's only, I think, 8 times EBIT.
All right.
So not terrible.
You didn't do anything on your watch list. I want to ask you, what's number one on your watch list that excites you?
I'm like a sideline supporter of Amazon every quarter.
Yeah, I still think it's a little cheap. But
maybe I should just own some shares.
Yeah, it still feels cheap to me, but it's up 100%, so it sucks.
Yeah. Visa's one where every time I dig into a financial company, I look at it and I think I should own Visa instead. Yeah, or you're helping Visa. Even with Wise, who has built out their own remittance network, the Wise card powered by Visa. I read an article the other day that's like Target's building out the Target Red Circle card or whatever to avoid some of the fees. And you look into it and you look into the fine print and it's still powered by Visa and MasterCard. You cannot get around them if you want to connect to bank accounts globally.
Yeah, check out. I have some notes for the newsletter that I'll put on Visa, but essentially, 30 times earnings, which right now, not really a big fan of, but 20 times earnings, it would be one of my favorite stocks. All right. Anything else before we wrap up, Ryan? Or are we good?
Last question here, are there any stocks you have that you just don't monitor that closely. Like you have no plans of selling it anytime soon. So like you get around to the quarterly report when you have some free time versus ones where you sit there and you're like waiting for the release and you're kind of constantly on the fence about whether or not you want to own it.
I think Nelnet would be that, except for on Twitter, it gets a lot of engagement because we're kind of known as one of the Nelnet people that tweet about it. So I like to be on that. But essentially, I don't really care what they even reported for Q1. It was nice to see their commentary this time, but that would be the one where set and forget it. Hopefully. Hopefully I didn't jinx that. Okay.
Let's wrap it.
Let's wrap things up. I will say this is a new concept we did, so let us know, one, if you don't like this, because we're testing out new stuff. If you really didn't like this podcast, it was a bad podcast, tell us, and we won't do it again. Second, tell us ways to maybe improve this. I was thinking that we have too many rankings. We should do each person for a separate episode. Let us know if that's a good idea. And then give us reviews, Apple, Spotify, wherever you get your podcast as a free podcast. That is the number one way to support us and tell us thank you. We've gotten quite a few, so appreciate that, but it's really the best way to help us out. All right, disclosure. We are not financial advisors. Anything we say on this episode is not formal advice or recommendation. Ryan, I, or any guest on this podcast may hold securities discussed on the show, may have held them in the past, and may buy, sell, or hold them in the future. That is a very important one. On the portfolio episode, we may buy, sell, or hold any of these stocks in the future, but we we always have a rule of not doing it within a couple days before or after an episode launches. Even though we're a small podcast, we want to be as ethical as possible and act like we would if we were a bigger one. All right. Thank you, everyone, and we'll see you next time.